Good afternoon, everybody. Oh, boy. Good afternoon. I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA/SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. My position disclosure is the same as yesterday, except I'm out of my Palantir short. All right, so market's trading up 50 cents after hours, but even with that, we're down 1% in the SPYs. Qs are up 50 cents after hours. Even with that, we're down over 1.5% in the Qs. IWM is up 20 cents after hours. Even with that, down 0.75%. So a little bit of relative strength there compared to the NASDAQ. TLT was up. Interest rates are down. Not by a big amount, but it's decently off of lows intraday. So decent intraday move. All right. How did the VIX end up doing today, out of curiosity? Bounced back a little bit. All right. Day before, I am tired. Day before the Fed day. Expectations day before the Fed day, especially after a big 2-day bounce, are basically to not have expectations. That's pretty much it. Chop, sideways action, more boring price action. A lot of times market participants are not looking to do a lot of new risk taking right before the Fed, particularly the day of. So that'll be tomorrow. So I'll give my spiel in the morning meeting tomorrow about how the opening price action can have your normal momentum signs, but starting at 10:30, 11 through 2 o'clock, it's usually very, very boring midday, the day of the Fed, and you don't want to overly push it. And today felt like a day to not overly push it either. My thought process based off of yesterday's closing price is that the market, as of yesterday's close, entered into an area of not great risk reward for putting on any new positions. If you're buying, you're chasing. You're chasing $17 as of yesterday's close off of absolute lows that happened after just 2 trading sessions in the SPYs. If you're buying at yesterday's close today, you are counting on a day 3 to the upside in a very weak market. It's not a good risk reward or probability of success. It's not something that you want to buy. If you're shorting at yesterday's close, maybe you can get away with it. My upside target on the bounce is a very wide range. Like I keep saying, it's a space between 570 and 572. We basically got to 570 yesterday. So to want to short after a 570 potential pivot high touch, not necessarily a terrible idea, but I don't love it because I do think, and to some degree still think, despite today's down day, that there is a risk of an overshoot to the upside before an actual pivot high were to come into the market. It seems like there are some market dynamics out there right now that could help with that actually on the upside, but only if we are to trade higher. If we trade higher, it's something that can feed on itself. Today we never traded higher, so the market never had an opportunity to feed on itself to the upside. So potentially a short, but if you're starting to short between 567 and 570 and we get to the upper band of my bounce back target, which is 582, then you need to be making sure that you're managing your risk and stopping yourself out quickly, or you're going to be enduring a lot of pain. So my general thought process, kind of based off of yesterday's closing price, was that it's not a good risk reward to do much new. So I wasn't planning on doing much new today unless we had a bigger movement in the market, which eventually we did. We had a very, very heavy, hard sell-off in the beginning of the day that I was not expecting, to be totally honest. I'm not surprised. Very little surprises me in the market at this point, but really did not meet my expectations. And it oversold us to the point where I actually did take some fairly decent day trade longs today, which are basically 1, 2, 3, 4, 5, 6. 5 of my 6 best P&L positions today are basically day trades. The Qs, Amazon, Meta, Nvidia are basically my best names, and they were all day trades off of that downside extension that we actually reached intraday, and they were all to the long side. They weren't necessarily easy. Especially, I was a good bit out of the money on my Meta position at a certain point in that down move when it was acting relatively weak, but they all ended up kind of working out for me. So I actually ended up day trading a good bit more today than I expected to do, just because we were so weak early on. But the bottom line is we had a little bit of a pullback in the market and we had a little bit of a bounce back in the VIX. I remember, I think it was just yesterday, someone was asking about the VIX and if I'm concerned about the VIX pulling back more than the market has bounced. And I said, like, yes and no at the same time. Like not really, but a little bit, because after uh, 5 down days in a row, basically in the VIX, and we certainly have not had 5 up days in a row in the market. What happens if the VIX gives a little bit of a bounce back, which it did today, and then the market just kind of got wrecked off that little bounce back in the VIX in the beginning. So um, that's actually what ended up happening, and we discussed that possibility a little bit in the afternoon meeting. But the pullback felt huge and violent today. And again, Nasdaq closing down 1.75%, was down over 2% at a certain point. I'm pretty sure today. It felt like a really big down day. But when you look at it on the daily chart in the context of where we came from that 550 low, it's not necessarily the end of the up move. It could be. This could be that, very shallow pivot high at the lower band of my target of the bounce, that then brings us all the way back down. But as much as that's a possibility, I also think that there's a possibility that you get like a little bit of a higher low or wedge type pattern that still could actually break to the upside to fulfill things. With that said, every day that goes by that we don't get a bounce, then it becomes more difficult to get that bounce to get deeper, higher, deeper to the upside. So, in other words, every day that we don't continue to move higher, this 21 EMA is going to continue to decline to lower prices. And that's like a good upper band target for a bounce, keeping in mind that it's not impossible or unusual, especially in a lower liquidity environment like we're in right now, to even get an overshoot of that 21 EMA, get an upside tail that could be several dollars above it as an actual pivot. So I think that that's still in the cards. But again, every day that goes by that we don't get that upside continuation, it just brings the target of that bounce trade, that secondary target, I would say we got to the first target, uh, lower. So you're reducing the reward profile over time of a bounce that comes in. I don't think it's necessarily shot though. It'll be shot if we're probably below 555 tomorrow after the Fed. Then it's probably shot to see that 580 plus move that I was originally looking for. But for the moment, I think it still could muster up that rally. We'll see what happens with the Fed. I don't have a good feel on this Fed event for tomorrow, to be totally honest. It'd be really interesting to see what the language is. We know that there's not going to be any change in interest rates tomorrow. It's all going to be about economic projections and the language that comes from Powell, especially during the Q&A. So we'll just take that as it comes. But overall today, yeah, really, really violent initially to the downside. You can see that here on this 5-minute chart. 3 heavy red bars in a row. The 4th bar gave a downside tail, but 0 bounce off of it. 2 bars after that, we immediately broke lows again. That's an extremely weak market. Usually, if you get a very heavy sell and then a downside tail on the 4th bar, you get a bigger bounce off of that to at least test that 80MA on the 5-minute chart. Even if you're going to continue lower, you get like a short-term dead cat bounce, if you will, back to that 80MA before failure. And if you are buying that low, you can book your profit, cover your risk, potentially even make money on just a touch to the 80MA before the failure comes. And that's assuming you even get the failure. Maybe you get an even bigger bounce on that enables you to make more money. So I liked the idea of looking long off this 4th candle. It failed very, very quickly. We tried again here at 10 a.m. It failed again. Finally, we got like a very not great bounce. I mean, this was just a super weak market for the first hour of the day. There were certain points in here where I remember looking at this 10:05 high, thinking if we could get above that 10:05 high, maybe we round up to at least the 80 EMA on the 15-minute chart, which is a similar price to the 21 EMA on the 5, and we didn't. We still couldn't do that. We were able to get above the 10:05 pivot, just to fail, and then make new lows again on the day. So first hour and a half of the day today, extremely weak. Remainder of the day, extremely boring. We really just got stuck in this sideways range here for the rest of the day. This price action between 11 and 4 today was what I was expecting from the entirety of today, but I thought that it would happen more in like a range between, I don't know, 563.50 and 566, something like that. Basically this action for most of the day, and it's not what happened. We sold very hard in the beginning to then get that like pre-fed range at weaker levels with the market down by a good amount on a percentage basis. We did close a little bit off lows. It's not enough of a tail to be excited about. If you're trying to be bullish, you wanted to see today's candle really give you like a potential higher low pivot, and we didn't close enough. We didn't close well enough to actually get that. So certainly weak market today. All from the beginning of the day was not great. At a certain point, I did come in and put on those day trades, and Amazon, which some of these names blew through their March lows. Amazon, when it ticked through its March low at 190.85, there was a wave of selling of stop losses that came in. I mean, you can see it here on this 940 candle. I actually bought that, and it turned into being a pretty good trade for me by the end of the day. Meta, similar, new March lows, broke new recent lows here, basically tested the 200 day. Really, really nasty. I bought this one as well. Could not get a good bounce back. This thing was worse than the market between 10 and 11. So I was a good bit out of the money on this thing at a certain point, and then was able to get the round back higher, and I traded it well enough that I was able to actually make fairly okay money in it. But it was another one that was just super, super weak, broke that daily chart low, not good. And then the other one that I bought more based off the market, even though I knew it had an event in the day around the same time, was NVIDIA. So NVIDIA and Amazon, I was able to kind of get off lows, and the trade treated me really well. Meta was not good, but eventually was able to roll up, and I was able to make a few dollars in that as well. So, a couple bucks on an intraday basis that I'll certainly take from some of these day trades to make up for a nice loss overall on my day, primarily resulting from just a bleed out in the swing longs that I have. Unfortunately, I was really hoping, and hoping is a four-letter word in trading for sure, to be able to get a little bit more follow through, and like at least like not necessarily even a full day 3, but even if I could have gotten like a day 2.5 that led to an upside tail, and then we weakened out, it would have been really enough for me to start to really de-risk some of these long positions in a major way. So unfortunately, this bounce, and I'm mentally prepared for that. I knew it could happen. This 2-day bounce was not enough for me to really de-risk. I have a little bit, but really de-risk on some of my longs that I have from lows. So, when you have almost a 2% down day of the NASDAQ, and you didn't have the opportunity to de-risk as much as I wanted to, it certainly negatively impacted my P&L just off the heaviness of some of the swings that I still have on, which is what it is. I'm just going to manage the positions still to my game plans. Like I said, I don't think it's out of the question that we still get a deeper bounce to the upside, but time is not a bull's friend here. A 21 EMA continues to get lower, but we'll see what happens with the Fed. So it kind of, I think, wraps up my summary of the day. I don't really have anything else to talk about, but I am, like always, more than happy to answer any questions from any traders. So first thing here that I'm seeing is from J. Cole. Any thoughts on treasury rates not going down as much as equities during this drawdown? Any thoughts on treasury rates not going down as much in this drawdown? You just mean like today in particular, like the TLT should have rallied more, I assume is what you mean. I mean, it certainly did rally a good bit in intraday off of lows. So, um, and at this point, I think we've kind of identified that the relationship. Excuse me, still a little bit under the weather. um, I think that we've kind of identified that the relationship with interest rates to the market is flipped. So now what we are seeing is when TLT moves higher and interest rates move lower, the market is typically going down on that because it's become a fear trade. I certainly am seeing a flight to safety more recently in this since this market sell-off happened. It's really starting in mid-February. I mean, we saw the market begin to get smoked as this TLT was moving higher and interest rates were moving down. And as the market now has continued to get smoked, it's kind of held in a little bit. And then again today, when we actually had a real sell day today, the TLT went from red to green and caught a really big bid back up. So to me, this still looks more like a safety play, a fear trade, a little bit on the economy. Maybe not with a perfect balance to it, but that's what I'm still seeing. I'm still seeing, for the most part, market participants are taking money out of U.S. equities. They're buying treasuries. They're buying gold. They're buying Europe. Europe closed on highs again today. They're buying China. They are not buying the USA. So that's what I continue to see on a down move like today when I see TLT go from red to green. But it's a constantly evolving situation, that relationship. So we'll keep paying attention to it day to day. From Richard, can we say how the market trade the Fed talk on tomorrow and how it trades Friday would be more or less set the tone of whether we will have a bigger balance to 50 to 570 to 582 or more bleeding? Yeah. So generally speaking, I think that what happens tomorrow is going to largely dictate the degree of any continuation of a bounce. The Fed day itself at 2 o'clock a lot of times is very reactionary in nature. A lot of times it's the day after the Fed day that you get the bigger, more trending movements from the market. So we'll see tomorrow what the reaction is between 2 and 4 o'clock, but there's a good chance that a bigger move, if it's going to happen, actually happens on Thursday. From Rex, with today's trading session, thinking the market wasn't going to sell off like this, so I took some 5-minute RDRs around 10 a.m., but most of them failed. Yeah, I mean, not surprised when most of them failed because the market failed, right? I liked the trade. I just kind of went over it. I liked the trade long on 945 off the tail low. It failed. I liked the trade long off the 10 a.m. low. It also failed, but maybe gave enough of a little bit of a bounce to get some risk covered. But if the market's going to fail, then most of the names that you're going to looking at are going to fail. So, Tesla is not the one I would buy. It's the worst one that's out there for so many reasons. You could have gone after Apple. Meta was really bad, but you could have gone after Meta, Google, Amazon. I mean, Google is not a good one today either because it's trading on news. So I don't like your name selection here. If you were looking for longs related off the potential of a market bounce here, Meta I know ended up being really weak. I don't hate it, but go after Microsoft, go after Amazon, go after even potentially Apple. Don't buy Tesla, which is the worst one that's out there, and don't buy Google, which is the one that's trading on news. So it's going to trade a little bit more independently to the market. So most of them failed, got shaken out, or break even. Would you, those RDRs weren't worth taking at all for the account size that can only take one shot trade instead of building up? I feel like myself personally not able to catch those bounces at all when the market bounced eventually. I was always too early or unable to catch those trades. Yeah, so just going to reiterate what I just said. I like those longs in those places. I like those 10 a.m. longs that you said there. I just don't like your name selection, particularly Tesla and Google in the name selection. I think Meta's fine, Amazon's fine, the other ones are fine, but not the news one and not the worst, weakest one. So hope that helps. From Rakas, Reddit crashed in the beginning of the day, like most things. I thought it might be weak, but couldn't see a setup that warranted a short right off the open. Wonder how you saw the beginning of the day. Yeah, I mean, you can't capture every move in the market. I think that especially capturing the short today off the open is extremely, extremely difficult. We already discussed the big picture in the market being a difficult spot to be putting on new risk. You're going to chase a gap down after that 2-day bounce to be able to put on shorts at the open and the day before the Fed when we're primarily expecting sideways price action. Just because price moves in a certain way when we're reviewing it at the end of the day does not necessarily mean that it was the right thing to do to put the trade on that could have caught it. I would stand by not shorting this market. Even in hindsight, I stand by not shorting this market off the open. I don't think it's a good trade. You're having a large gap down at that point, and then you get momentum down off the open. There's no trade setup to short that's giving you an actual setup, that's giving you an actual good risk reward. So, sometimes the market just does things, especially sometimes the market just does like lower probability things. So I would argue that that's what happened today. And there's you just don't have an edge, and when you don't have an edge, there's nothing you can do. And the worst thing you can do is see a market move that doesn't coincide with your edge and pull your hair out about how you should have caught it, because you shouldn't have caught it. Is my opinion on it. So hope that helps. From Eli, do you ever in certain markets choose to size down? So I want to make sure that we are first using that term properly, size down. So what sizing down is not, in my opinion, which is what you should do as volatility increases. So as volatility increases, you should be, generally speaking, taking less tier size on your trades. In a normal market, maybe you take 1,000 shares. Now in this market, you're taking 500 shares. But you're giving it more space risk. So in a normal market, maybe you're giving it 25 cents of room on that 1,000 shares. In this market, because volatility increased, maybe you're giving it 50 cents worth of room on the 500 shares. That's not sizing down. When I think about sizing down, I think about sizing down the risk that I'm putting on the trade. So I'm going to say no. I'm not going to size down the risk that I put on in the trade based off of a market condition. I will be sizing down the size itself on the trade, but not the dollar risk that I'm taking. Generally speaking, it's a good idea as volatility increases. When you should size down the risk on your trading isn't necessarily to do with market conditions. It's more to do with how you are trading in any given market environment. Especially traders that are newer to the business, part of the learning process that makes this business so difficult for newer traders as they first get started is that the environment is constantly changing. The market cycle is doing its thing. And let's say that you are 1 year into your trading career, and that first 1 year, all you've known is a low volatility bull market. And after a year, you're making really good progress. You're starting to make good money. You've really learned this market environment. You've learned some strategies that pay great in an environment where you are trending higher with low volatility. And then all of a sudden, just as you think that you're really starting to figure things out as a trader who's 1 year into his career, the environment changes, and all of a sudden you see yourself consistently losing money because the strategies that you were using in a low volatility uptrending market do not work in a high volatility downtrending market, as an example. That's the reason to size down isn't because of the market conditions. The reason to size down is because you're not doing as well anymore, and that's because it's an environment that you haven't seen, that you haven't really developed an edge for yet. That is again, one of the really difficult parts about trading is the kind of the 2 steps forward, 1 step back concept. that traders probably have to go through for the first 10 years of their career, to be totally honest. Where it's like, all right, I got it all figured out, and then the market changes, and you take a big step back. You take some losses, you have to make some adjustments, you have to figure out what's done differently. And by the way, that's one of the biggest killers of traders who have been doing this for a little while and have shown success in the past, is that people get too stubborn. They get too stubborn. They don't want to size down when they are in a new environment that they can't figure out. They don't want to make changes because what I was doing was working. I was making money every day, and now it's not, and I'm gonna make money again now. Um, you just need to recognize, if you're a trader who's in the first 10 years of his or her career, that you're going to see different environments that you haven't seen previously, and um, you're going to need to make trading strategy and approach adjustments to those new environments, and that adjustments like a growing pain of figuring out, well, what changed, what's different, and what do I need to do different in order to be successful. So, I know for you personally that you're still in the first 10 years of your career. So it could just be that you have entered a point here where the environment has changed, and maybe you need to be sizing down because you're entering a new environment where you need to be doing new changes. But for me, um, I've been through enough market cycles in my career where none of them are ever exactly the same, but a lot of them, when you've been doing it for as long as I have, they rhyme. So this environment that we're seeing now, still a little bit new, right? I was saying just last week, the degree of how we were holding the downside extension was something I'd never seen before. The fact that we saw short-term tactical in the green six trading sessions in a row was not something I had ever seen before. But very fast market corrections of 10% are things that I've seen before. High volatility environments are things that I've seen before. So for me, this is a little bit unique of an environment, but it certainly rhymes with other environments that I've seen. And as a result, I'm more able to make quicker adjustments to my trading because I've kind of seen this before, even if it's a little bit different, a little bit unique. So hope that helps. I really think it's just part of the process. No problem, Richard. Another thought, maybe we should increase our portfolio weight on China names a bit. I've been saying it for a while. I said it again in the morning meeting this morning. I'm upset that I'm not back long Alibaba. Though maybe Alibaba ends up giving a failed breakout if it gets back below 140. But I'm upset I didn't get back involved in these positions. I like them a lot. I love the bulk consolidation that Alibaba has built out. I love the idea that we're going to continue to see. I don't love the idea itself, but I think that the thought process is correct, that we're going to continue to see some degree of rotation out of the US and into foreign markets, into Europe, into China. So I like the idea of being long these names as they give the setups. That's where the strength is. This is where this look at this chart. Beautiful bull flagging chart here compared to almost anything else that's out there. It's exactly the type of chart that you generally want to be long. And yeah, the AI story is one of the things that kicked it off. I would still argue that fundamentally these companies are extremely, extremely cheap. The BYD electric car data that was out this morning about how BYD's electric car charging technology is just absolutely crushing Tesla's electric car charging technology. It's really definitely just one thing after the next that points towards that's where you want to be. So for sure. Cool. Looks like I got through the questions here, at least initially in this VTF. Give me 1 second. I got one of my positions popping a bit in my favor. Anybody see anything on SPIR right now? Cool. Dig it. Thanks, Josh. Nice. Let's go. Sorry, just one more second. I'm going to pop over to the YouTube. All right. From Kevin G in the YouTube. Once a spy double bottom at 11:55, failed to break the VWAP at 12:30. It was a confirmation. A day 3 rebid was unlikely. Yeah, I had a similar but different thought process when we couldn't break up at a certain point today. There was a couple times when this market tried to break through, consistently failed, and it just seemed like it wasn't going to be able to happen. For sure, Kevin. From Steven, any thoughts on NIO? So, my people on the ground in China tell me that NIO is the worst of the electric car companies. That's not to say it can't go up, but it sounds like that LI is a little bit more of a leader. BYD, which we don't have access to, is certainly the leader. And then like NIO, well, probably XPEV is then next. XPEV like not as good as LI, not as good as BYD, but better than NIO. And then NIO's the worst one. That's just what people I know who live in China who see the vehicles, and some of them even own them, have kind of told me. So it's more anecdotal than anything. But the charts seem to confirm it. NIO has the worst chart, the worst bounce out of all of them. So not really too much of a thought process for you on that. It might be catching a little bit of a secondary move here just based off of China itself outperforming and some of the BYD news that came out. But yeah, and Richard is saying that maybe NIO has earnings on Friday, so I don't know that for sure, but it's something I would definitely want to confirm if I was going to be in it. So not my favorite one in the space for sure. From Kevin, do you have a physical playbook, sticky notes, anything written you keep on your desk in times of market change that serve as reminders? No, I don't. Not at this point. It's I just don't. I definitely have in the past. I've had sticky notes on the computer. I've had entire notebooks filled up with notes, handwritten notes. I don't anymore at this point. Just being totally honest. But I don't hate the idea. Do what you got to do to remind yourself to trade properly. Cool. Anything else for today? Big Fed day tomorrow. I don't mind doing a little bit of a shorter afternoon meeting today. So, all right, we'll wrap things up. Have a great night, everybody.